The stock market is coming off consecutive years in which we've seen it move 20% or higher. Now, this is incredible, but definitely not normal for the index. As we turn the page into 2025, we have new challenges, new tariffs, tax changes, pro-growth policies, but there's still a lot to be excited for, and you definitely want to have your portfolio prepared. As such, in today's video, we're going to be taking a look at 3 high-growth companies, all of them with 25% growth or higher price targets for 2025. So if you're ready to unveil these, do me a huge favor. Show your appreciation by simply clicking that like button down below. Subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we take a peek at today's stocks, let me remind you the importance of diversification when it comes to building wealth over the long term. And when I talk about diversification, that's just not talking about stocks. Even outside, high quality and a mix of asset classes is going to protect you against volatility. JP Morgan stressed this in their 2025 guidance report, saying that the traditional stock to bond or 60-40 portfolio may be reformed into one that also includes alternative assets. A 2022 report from Citi details an alternative asset class that actually has a negative correlation to developed market equities, i.e. stocks. Citi is actually talking about blue chip contemporary art, which may seem like an obscure asset class, until you consider the billionaires who sit on 9-figure plus art collections, like Microsoft's co-founder, Paul Allen. In fact, the overall art and collectible asset class is estimated at nearly $2.2 trillion by Deloitte, and it's expected to hit almost $2.9 trillion in 2026, leaving lots of room for potential upside. That's why I think you should check out today's sponsor, Masterworks, while you're still early to the scene. Their art investing platform has already distributed back a total of over $60 million in investor proceeds across their 23 exits. And you don't need to be an art expert to get involved. And you can diversify between multiple paintings. So if you're interested in learning more, but also receiving priority access, you can check out the QR code on your screen right now, or you can go down to the description where you'll find a link which will take you straight to my unique URL, which will get you that priority access. Past performance is not indicative of future returns. All investing involves risks. See important Regulation A disclosures at masterworks.com/CD. All right, let's jump back into the video, take a look at 3 stocks with huge upside. It's just not 3 stocks that I believe are going to jump higher. It's 3 stocks that analyst consensus believes are going to jump higher. And we're going to go through these from the lowest or the slowest growing company in terms of price target to the fastest growing company in terms of price target for 2025. And that's going to begin with stock number 1, which is NVDA, stock ticker NVDA. Now, NVIDIA needs no real introduction at all, as it is one of the largest 3 companies here in the US and really in the world for that matter. When it comes to NVIDIA, they have the best and most powerful AI chips on the market today. And when you look back over the past few years, AI has dominated the market. This is the company that has seen insane growth, and even with those tough comps moving forward, the growth is still coming. The company currently has a market cap of $3.3 trillion, making it the second largest company as of this video. And over the past 12 months, shares are up 145%, and over the past 3 years, up over 400%. You would be hard-pressed to find very many companies that could outperform NVIDIA over that 3-year stretch. And the exciting thing about it is the fact that I believe that AI is still in the early innings. Taiwan Semiconductor, the largest chip maker, who makes chips for NVIDIA, just reported strong earnings themselves, and they also reaffirmed their upbeat stance on AI moving forward. In terms of earnings, we're going to have to wait a little bit for NVIDIA because they won't be issuing their latest earnings report until the end of February. But what we can do is when these big hyperscalers start reporting their earnings in a few weeks here, you could see their spending, their AI spending, because a lot of that has been going towards NVIDIA. Again, this is a company that continues to grow its revenues by 1x and 2x over the past few years. So looking ahead at the estimates, the comparables are getting tougher and tougher. Take a look here at this chart and look at the revenue growth the past 5 years. From below $30 billion in annual revenues for NVIDIA to now well over $100 billion. In fact, when you take a look here, you can see that analysts expect the company to report nearly $130 billion in sales for their most recent fiscal year end, followed by 52% growth this year and nearly $200 billion in revenues, which is just rather astounding. In terms of earnings growth, analysts are looking for 50% growth the next 12 months, which equates to a PE ratio of just 30 times. And that, with the growth rate added in, gives this company a PEG ratio of 0.8 when I average out the growth rates over the next 24 months. That there is extremely intriguing. Analysts rate the stock a strong buy with an average 12-month price target of $177, implying nearly 30% upside from current levels. And again, this is going to be the lowest potential upside projection of all the stocks we look at today. And that leads us to stock number 2, which is going to be Uber Technologies, stock ticker UBER. This is a company that I've talked about a number of times in past videos, more recently, but it's one that I believe we continue to have an opportunity in. Even over the past month, shares of Uber have climbed over 12%. The company currently has a market cap of $144 billion, and over the past 12 months, shares are up just 7%. This compared to an S&P 500 that is up 26% over the past 12 months, meaning Uber is drastically underperforming. So what has weighed on the stock over the past few months? Well, it has been the expansion we have seen with Alphabet's Waymo, but more importantly, it's been the announcement or that event we had from Tesla around its robotaxi. Now, when it comes to Elon Musk, love him or hate him, he has brought some incredible inventions to the world in the past few years. Brilliant mind from that standpoint. However, when it comes to projections, when has he been even relatively close to those? Things like full self-driving years ago, the Cybertruck years late, going privately to the moon or going and landing on Mars. All of these things weren't even close. Many of those projections have already passed and still haven't come to fruition. So when you sit here and look at the robotaxi, which again only fits 2 people, he believes these will be here in late 2025 this year or early 2026. So that relatively means that we probably won't see these until, say, 2028. So this is, although it needs to be considered for Uber, it's not something that's relatively close. There is still plenty of upside when it comes to Uber. They too can coexist with these self-driving ride-sharing. And Uber has food delivery as well. After the pandemic, Uber saw its revenues hover around $10 billion. And in a few such years, revenues have 4x'd. More than $40 billion over the trailing 12 months. Another company with strong growth. Looking at future revenues, analysts are looking for the company to continue at a mid-teens growth rate for the next few years. And in terms of earnings growth, analysts are looking for nearly 25% earnings this year and 41% earnings growth the following year. That puts shares at a PE ratio of 29.5 times and a PEG ratio of 0.9. And I like to find value when growth stocks have a PEG ratio at least below 1.5, but really below 1. So we are getting great value for the expected growth ahead. In terms of analyst rating, they rate the stock a strong buy with an average 12-month price target of $92, implying more than 35% upside from current levels. And that leads us to stock number 3, which is Alibaba Group Holdings, stock ticker BABA. Now I realize this third stock isn't for everyone, as it is a play on China. And China is a region that I've stayed away from for roughly 5 years now. And looking back, that has proven to be the right move. However, if you're looking for a high risk, high reward type of growth play, Alibaba could be it. The company currently has a market cap of $187 billion, and over the past 12 months, shares are up 23%. However, over the past 5 years, they are down more than 60%. Again, the Chinese economy completely fell apart during the pandemic, and the government wasn't willing to do anything about it. And what happened? It went into shambles. However, now the Chinese government has had enough, and they have taken the steps to bring growth back by cutting interest rates and launching a 10-year, $1.4 trillion stimulus package. Although the stimulus is still working its way through and we're early in those stages, we have seen maybe a bottoming, as GDP for the fourth quarter just grew 5.4% in the region, surpassing expectations. The region is certainly not out of the woods by any means, but if you, again, are looking for a high risk in an area that has high potential growth areas, it's going to be the recovery in that Chinese market. Now, although the stock has not done well over the past 5 years, revenues have grown from $80 billion 5 years ago to nearly $135 billion over the trailing 12 months. But over the past few years, that's the same spot it's hovered. We need to see that top-line revenue growth return. Looking at future revenues, where analysts are looking for the company to return to positive growth over the next 12 months, looking at 8% growth each of the next 2 years. Not huge numbers by any means, but when you look here at earnings, which are expected to grow 12% and 10% the next few years respectively, we have a stock that's trading at a forward PE multiple in the single digits. That's half of the S&P 500, making for a stock to have a nice size ceiling with a floor that has moved higher. This gives the stock a PEG ratio of just 0.85, which is very intriguing. So you get great value for the growth that's expected. Analysts rate the stock a strong buy with an average 12-month price target of $118 per share, implying nearly 40% upside from current levels. But we gotta know the risks if you're going to be buying Alibaba. So there we just looked at 3 stocks with huge growth potential. We looked at a technology play in NVDA. We then went to an industrial play with Uber Technologies, and then a play on China with Alibaba. Again, there's a lot of risks there, but also high reward potential. Down in the comments section below, let me know which of these 3 stocks do you like best in terms of growth heading here into 2025. And if you haven't done so, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.